Readers, viewers, thanks again for joining me in our last but one segment with James DeMello of the SidebySide Partnership. In this series, you may have seen earlier on this month, or in this important run-up to tax year end, we've been covering some of the sort of issues, areas around the small print that the fund managers and EIS, VCT, SEIS, etc., don't always bring to the forefront of advisors' attention. James and his experience is here to just sort of open up that door and explore a little bit for us, and just tell you a few of the things you should know about. In this episode, I'm just going to ask James briefly to explain to us about tax relief, how that's worked out, and whether managers should include it in their returns. James, over to you.
Thanks, Alex, and yeah, thanks everyone for tuning in again to probably a very exciting soap opera style video. But tax relief and manager inclusion. Tax relief is a byproduct of SEIS, EIS, and DCTs. And BPR as well, BR as well. The main thing with tax relief that advisors need to be aware of, definitely, and it's more to the fact of, if a manager is investing in these products, yes, they qualify for tax relief, and managers have some work to do in order to find the right type of business that will qualify for SEIS, EIS, VCT. Therefore, arguably, some managers will say, well, then we should include the tax relief in our returns. I, for one, think it's just it's something that shouldn't happen. I don't understand how managers can claim sort of responsibility for an HMRC initiative and something that's pioneered by the likes of ESA and other trade bodies, but nonetheless, something that advisors and investors need to be cautious of. And again, this isn't pointed at any fund managers, but when you're looking at funds to invest in at tax year end, ask the managers, ask them if they do include it. Some managers are very upfront and they say that they include it, and they say it proudly, but there's a couple of things to touch on why it's important on each. So tax relief, some managers, when they talk about their target return, they will include tax relief within that figure. So if their target return is whatever, 1.3, no one has a target return that low, don't worry, but it's just for figure's sake, say it was, and they're including the 30% tax relief in that, then in reality, their target return is not 1.3. Now, why it's important when it comes to target returns and tax relief is, I guess, no one's misleading anyone, but it's a very good marketing sort of technique, but it's actually quite important to think, would you still have recommended that fund as the advisor, or would you still have invested in that fund as an investor if the target return was actually 30% lower than it is, or if the target return was advertised as it should be without the tax relief? Most managers have stopped doing this. There are still a few, so it's very well worth advisors' time to just ask the funds that you're looking at, do you include tax relief in your forecasts? So that's on target returns, because most managers will have a 2-3x target return. So if they're including tax relief within that, although it's a bit of a grey area, it shouldn't be happening. In today's age. I mean, the EIS has been around for 26-7 years. I think it's time managers stop claiming responsibility for tax relief. The other point is the fact on the performance hurdles. So we've touched in an earlier episode on performance hurdles. Some managers do include tax relief on their performance hurdle. So if they say we will charge 20% on any profitable returns, double check that they are not including the tax relief of EIS of 30% within that profitable return, because it's a very different outcome if the performance fees start being charged at 70% of return, 70% return on investment versus 100%. So again, it's just about giving advisors and investors the kind of ammunition to look for these things, because this stuff will not pop up in an IM. It's not featured in the sales brochure. It's not featured anywhere. So when you're looking at these funds and the managers are telling you about their target returns and their performance hurdles and all the rest of it, just very simply ask the question, does that include tax relief? And if it does, then again, deduct that, because for an advisor, when you come back to do your cash flow planning and things like that, although tax reliefs feature the same as they do on pensions and everything else and any IHT planning, the advisors don't, most advisors don't take credit for actual saving on IHT when they're investing into these products, but obviously they take credit for the work, as they should. But tax relief is a byproduct of these investments, and I mean, the tax tail shouldn't wag the investment dog, as it were, but also managers definitely shouldn't be claiming credit for it nowadays either.